You know, the stock market, it just feels like this crazy emotional roller coaster, right? It's confusing, it's fast, and honestly, it can be super stressful. But what if there was a simple way to cut right through all that noise?
Well, let's get into it.
And really, it all boils down to this one big question, doesn't it? Is the stock market just a giant casino, a place for wild bets where luck is king? Or is it a place where you can actually become a part owner in real thriving businesses? Because how you answer that, well, it changes absolutely everything about how you approach it.
So to help us figure that out, we're going to use this really cool mental model. It's something legendary investors use all the time to find clarity in all that chaos. And it's called the beer and foam framework. Just imagine any stock price as a big glass of beer. The beer itself, that's the company's real actual value. And that head of foam on top, yeah, that's just the market hype and speculation.
Okay, so the most important thing here is learning to see those two layers for what they are. See, your goal isn't to try and guess what the foam is going to do next. No way. The real goal is to understand the beer, so you know exactly what it is you're putting your money into.
All right, let's really break this down. The beer, that's the real business, right? We're talking sales, profits, the actual substance. And this stuff, it's pretty stable. It changes slowly, over years. But the foam, well, that's a whole different story. That's pure emotion. It's the daily news headlines, the crazy hype, the sudden fear. It's all about crowd psychology, and man, it can change in a heart.
So, if we're all in on focusing on the beer, how do we actually tell if it's any good? You know, how do we know if we're looking at a rich, delicious stout versus, I don't know, some cheap, watery lager? Well, it all comes down to one thing: digging into the company's financial health.
What we're looking for are kind of like the company's financial vital signs. You've got return on equity, which basically tells you how good the company is at turning your money into more money. Then there's low debt. That's a huge sign of stability. And my favorite, strong free cash flow. That's the actual real cash left over for the owners at the end of the day. And here's the kicker. When you see all this happening consistently for 10 years or more, you know that quality beer is the real deal, not just a one-time thing.
And you know who's a perfect example of this shift in thinking? Warren Buffett himself. His whole strategy evolved over time. Early on, he had this cigar butt strategy. Basically, he'd find these dying businesses on the cheap, just to get one last puff of profit out of them. But then, his partner Charlie Munger came along and completely changed his perspective. Buffett shifted to buying wonderful companies at fair prices, because he finally realized that real quality, that's the true engine for long-term growth.
So what exactly makes a company wonderful in his eyes? It's one thing: a powerful economic moat. This is probably Buffett's most famous metaphor, and it's brilliant. Think of the business as a castle, and the moat is this huge, sustainable competitive advantage that protects it. It stops competitors from storming the walls and stealing all the profits. And the logic is simple: the wider that moat, the safer the castle. And these moats, they come from a few key places. First, you've got just sheer brand power. Think Coca-Cola. People just buy it without even thinking. Then a company might have a massive cost advantage that nobody else can touch. Or there's the network effect, like a social media site that just gets more and more powerful the more people join. These are the kinds of defenses that really protect the beer we're looking for.
Okay, so we've figured out how to analyze the beer. Awesome. But here's the thing. That's only half the battle. The other half, and honestly, this might be the tougher part, is building up the mental strength, the discipline, to just ignore all that noisy, distracting foam.
And to help with that, let's pull out another fantastic analogy. This one's called Mr. Market. Just imagine the stock market is this emotional business partner. Every single day he shows up at your door. Some days he's ecstatic, other days he's totally depressed. And every time he's yelling some crazy price at you, offering to buy your shares or sell you his. The absolute key is to remember that his crazy moods are your opportunity. They should never be your guide. He's there to serve you, not tell you what to do. Buffett has a great way of explaining this using a baseball analogy from the legendary Ted Williams. He says investing is like being at bat, but with one huge difference. There are no called strikes. You can just stand there at the plate all day long. You don't have to swing at every pitch, at every stock that comes your way. You can just wait and wait and wait for that one perfect pitch, that one great company that you totally get landing right in your sweet spot.
And here's one more powerful mental tool to really lock this in. Imagine you were handed a punch card, okay? And on that card are only 20 slots for your entire investing lifetime.
Every single investment you make uses up one of those precious punches. All of a sudden, you'd get a whole lot more careful, wouldn't you? You'd do your homework, you'd do deep research, and you would make absolutely sure that every single decision counted.
So the big question is, how do we put all these pieces together, right? How do we connect our deep analysis of the beer with the crazy opportunities the foam throws at us? Well, this brings us to what might be the single most important principle in all of value investing.
It's called the margin of safety. And the idea is actually super simple. Figure out what the beer is really worth, and then you wait. You wait for all that market foam to die down so you can buy it for way, way less. That discount, that's your buffer. That's your protection against being wrong, against plain old bad luck, against a future that, let's face it, none of us can predict. Here's exactly how it works in practice. Step 1, you do your homework. You analyze the business and you figure out the beer is worth, let's say, $1 a share. Step 2, you wait. You just sit back and let our old friend, Mr. Market, get all gloomy and pessimistic, and you watch the foam push that price down. And then, step 3, when he finally comes to you offering it for just 60 cents, bam, you buy it. And just like that, you've got yourself a 40-cent margin of safety.
All right, let's look at a real-world example of this in action. And it doesn't get much more famous than this one. Warren Buffett's legendary purchase of Coca-Cola stock way back in 1988.
So get this. Back then, the market, which was just looking at the foam, right, valued Coke at about $14.8 billion. But Buffett, he looked at the beer. He saw the insane power of its global brand, its ability to raise prices, that massive economic moat we talked about, and he calculated its real intrinsic value was more than 3 times higher, something like $48 billion. I mean, talk about a massive margin of safety. And the result? Well, by 2012, his $1.3 billion investment had ballooned to over $14.5 billion. And that's not even counting all the dividends he collected for decades. Now that is the power of focusing on the beer and using the foam to grab an incredible bargain. And this whole way of thinking, it's totally timeless. Think about it. Back during the dot-com bubble in '99, what did Buffett do? He saw way too much foam and just stayed away from tech stocks. And what about right now with all the crazy hype around AI? What's he doing? He's sitting on a record pile of cash, parked in safe T-bills. That's him sending a huge signal. He's telling us he sees a whole lot of foam out there and not a lot of quality beer being sold at a safe price. So that really leaves us with one final big question to think about. Right now, the world's best, most disciplined investors are seeing a ton of froth, and they're choosing to just sit on the sidelines, patiently waiting for a better pitch. So when you look at the market today, when you look at your own investments, what do you see in your glass? Are you looking at the beer, or are you getting distracted by the foam?